Governments love to tell you they're working for your financial freedom. They promise stability, growth, opportunity. But history tells a very different story. For over 2,000 years, governments have used the same hidden financial tricks to keep ordinary people broke while quietly transferring wealth upward. And the shocking part? None of it is new. Ancient Rome did it first. When emperors ran out of money, they didn't raise taxes, they debased the currency. Same coin, less silver. Inflation exploded. Savings vanished. A silent tax on the people. Centuries later, kings forced merchants to lend money to the crown. Refuse, and you lost everything. They called it duty. It was theft with paperwork. Today, the tricks were suits and spreadsheets. Inflation, government debt, bailouts, money printed out of thin air. The language changed, the game didn't. The wealthy lend money to governments and earn guaranteed returns. The public pays through higher prices, higher taxes, and weaker currencies. Different century, same system. And if you don't recognize the trick, you'll keep paying for it. Governments love to tell you they're working for your financial freedom. They talk about stability, growth, and opportunity. But if you look closely at history, you'll see something far darker. Governments have always relied on hidden financial tricks to keep ordinary people struggling, while quietly consolidating wealth and power for themselves. And the most shocking part? These tricks are not new. They've been recycled for centuries, wrapped in different language, sold under new names, but always serving the same purpose: transferring wealth upward and keeping the majority dependent. Let's start with the oldest and simplest trick of all: inflation. When a government spends more than it can collect through taxes, it faces two choices. It can be honest and tax its citizens openly, which is politically dangerous. Or it can quietly reduce the value of money itself, shrinking the worth of every coin and every note in circulation. Ancient Rome mastered this technique. In the 3rd century AD, emperors facing rising military costs began reducing the silver content of the denarius. A coin that once held nearly pure silver slowly turned into copper, coated with thin silver layer. Officially, nothing had changed, but in reality, everyone holding those coins paid the price. Inflation surged, savings evaporated, wages lagged behind rising costs. It was a silent tax on the population, a tactic still used today, just through central banks instead of imperial mints. In the Middle Ages, the trick evolved into forced loans. Kings in England, France, and Spain routinely pressured wealthy merchants and guilds to lend money to the crown. These loans were rarely voluntary. Refusal meant fines, confiscation, or worse. Sometimes repayment was promised with interest, but often arrived late, in devalued currency or not at all. The crown funded its wars and palaces, while merchants were stripped of capital under the banner of patriotism and duty. And it worked for centuries. By the 17th century, the financial system itself became the trick. When Britain founded the Bank of England in 1694, it wasn't an act of generosity. It was a necessity. The government needed money to fight wars against France. Wealthy investors purchased government bonds, and in return, the crown guaranteed interest payments funded by taxes. On the surface, it seemed fair. But those taxes fell on ordinary people, through duties on everyday goods like salt, beer, and cloth. The wealthy earned secure returns. The poor paid the bill. It was a wealth transfer system disguised as national finance, and it set a pattern that still defines a modern world. Even today, the safest investments are loans to governments, and those returns are ultimately guaranteed by the labor and consumption of the masses. Fast forward to the modern era, and the tricks are everywhere. Take deficit spending. Governments pile up massive debts by issuing bonds bought by banks, investors, and foreign powers. Politicians sell this as funding for jobs, infrastructure, or social programs. But much of the money flows into defense contractors, corporate subsidies, and bailouts. When repayment comes due, spending at the top is rarely cut. Instead, taxes rise, inflation increases, or social benefits are reduced. The debt is framed as serving the people, but the burden lands squarely on them, while profits flow upward. Then there are bailouts. During the 2008 financial crisis, banks made reckless bets, bundled toxic mortgages, and nearly collapsed the global economy. Who paid for it? Ordinary taxpayers. who emerged stronger. The same banks, now bigger and more concentrated than before. The trick was simple: privatize the gains, socialize the losses, and tell the public it was necessary to save the system. Even pensions and retirement systems are built on financial sleight of hand. For decades, people in the United States, Britain, and across Europe paid into government-managed retirement programs, trusting their money was being saved. In reality, most governments spent it immediately and replaced it with IOUs. The promise was that future taxpayers would cover the cost. It's essentially a generational Ponzi scheme dressed in official language. It works until demographics shift, populations age, and suddenly the system becomes unsustainable. Then come the reforms: reduced benefits, higher retirement ages, or payouts quietly eroded by inflation. The pattern is always the same. Inflation is sold as growth. Forced loans are framed as duty. Debt is marketed as investment. Bailouts are labeled stability. Pension cuts are called reform. The language hides reality: a steady transfer of wealth from the many to the few. In recent decades, the tricks have become more sophisticated. Consider quantitative easing, a term almost no one had heard before 2008. Central banks created trillions of dollars out of nothing, buying government bonds and mortgage-backed securities to stabilize markets. And it worked for the financial system. Asset prices exploded. Stocks, real estate, and bonds surged. But who owned those assets? Mostly the wealthy. For average households, the benefits were limited, while the downside showed up as distorted markets and rising living costs. The system was saved for those at the top, while inequality deepened for everyone else. Stealth taxation is another modern trick. Instead of openly raising income taxes, governments quietly tax through sales taxes, fuel duties, and, most importantly, inflation. When prices rise faster than wages, purchasing power shrinks. Governments benefit because inflation reduces the real value of their debts. Citizens pay the price through eroded savings and financial insecurity. Inflation isn't a flaw in the system. It's one of its most reliable tools. Then there's regulatory capture. Regulations are supposed to protect the public, but history shows powerful industries often control the regulators meant to oversee them. Railroads in the 19th century, oil in the 20th, tech and finance today. It's the same logic made famous by the Peaky Blinders. Don't fight the game, own the referee. The public sees protection. Insiders see profit. War finance is another ancient trick dressed in modern clothing. During the World Wars, governments sold bonds as patriotic duty. Citizens believed they were supporting their country, and they were. But these bonds also became safe, profitable investments for the wealthy, guaranteed by future taxes. In the 21st century, wars in Iraq and Afghanistan followed the same pattern. Trillions funded through debt, enriching contractors and financiers, while ordinary taxpayers carry the burden for generations. Finally, governments weaponize complexity itself. Tax codes thousands of pages long. Financial instruments even experts struggle to explain. Budgets buried in jargon and acronyms. Complexity becomes camouflage. When people can't follow the money, they can't resist the transfer. In Rome, debased coins were visible. Today, the trick hides in spreadsheets and balance sheets. Why does this matter now? Because these tricks aren't fading, they're accelerating. Inflation eats away at savings. Debt grows year after year. Bailouts remain the default response to crisis. Central banks manipulate money supply, while costs are passed quietly onto the public. Different eras, same mechanism. And here's the harsh truth. Most people never escape these traps because they don't realize they exist. They accept inflation as normal, taxes as unavoidable, bailouts as necessary. Ignorance becomes the most powerful trick of all. That's why financial education matters. Economic history is a weapon. When you understand the tricks, you become harder to manipulate. So remember this, always look past the headlines. When governments announce stimulus, ask who benefits first. When inflation rises, remember it is policy, not accident. When regulations appear, ask who wrote them. Build real wealth outside the traps. Never assume the system exists to protect you. It exists to protect itself. The financial tricks that drain Roman citizens are the same ones draining your bank account today. Only the language has changed. If this gave you a new perspective, subscribe. History has the answers.